Welcome to the Deep Dive, where we cut through the noise, we stack up the research, and we pull out the insights you need to get the big picture fast. So today, we're really going to get into one of those fundamental tensions in personal finance. It's that trade-off, right, between having total investment freedom and then the discipline you need to actually manage it.
Yeah, the consequences of that freedom.
Exactly. How do you get the ability to invest in, well, anything, anywhere on the planet?
Yeah.
And more importantly, what's the real price tag for that kind of access? We are diving deep into the Compte Ordinaire. That's the French Ordinary Securities Account, or CTO. It's a tool that offers, total liberty, but it demands some serious strategic thinking, especially when it comes to taxes.
I think this is perfectly framed by a quote from Carl Richards. He said, "Flexibility is a weapon, but it demands a disciplined shooter."
That's a great way to put it.
And the CTO really is the most flexible weapon an investor in France has. It removes all the guardrails. But if you're not disciplined, especially with taxes, you can end up hurting your own returns.
Okay, so before we unpack this weapon, just a quick but necessary reminder, this is for research and education. It's not personalized investment advice.
Right. We're just talking about how these things work. We're not telling you what to buy or sell.
Markets are uncertain, and you're the one driving your own choices. Okay, let's get into it. What exactly is the CTO? Why is it sort of the default investment tool?
Well, to put it simply, it's the most comprehensive and unrestricted account there is. Its whole point is to give you access to all global markets. No limits on geography, asset class, or how much you can put in.
So it's the account you use when what you want to buy just won't fit anywhere else.
That's it, exactly.
The name, Ordinary Securities Account, it sounds so mundane. It almost hides how incredibly broad its scope is.
It really is. The range is just vast.
Right.
We're talking global stocks. So that includes U.S. tech giants, emerging markets. Then you have all kinds of ETFs, bonds, commodities.
Even more volatile stuff.
And even volatile assets like cryptocurrencies, yeah. If you can trade it, you can probably hold it in a CTO.
So that right there, that defines the target user pretty clearly.
Precisely. The source material calls it perfect for autonomous and curious investors.
Okay.
This is for the person who's done their homework, who wants to buy a specific stock in, say, Shanghai, or hold a U.S. Treasury ETF. If you want a truly global portfolio, the CTO is your canvas.
And this is where it gets really interesting strategically. Let's talk about the upside, that total liberty. The freedom of the CTO really comes in, what, three main flavors?
Yeah, three big ones. The first is just simple, but so important. No limits.
No ceiling.
No ceiling at all.
Yep.
Unlike other accounts that have contribution caps, the CTO has no maximum investment limit. Doesn't matter if it's 100 euros or 10 million, the account can take it.
Okay, and the second one is probably the biggest differentiator. No restrictions. This is where it really stands out against its main rival, the PEA.
The PEA is great, but it's mostly for European stocks and certain EU funds.
It's got those geographical handcuffs on.
Exactly. The CTO is how you get them off. You're not stuck in the EU. You can buy those non-eligible ETFs. You can track foreign indices. You can own those huge American tech stocks that, let's be honest, are a core part of any modern portfolio.
So the PEA gives you a tax break, but limits your map. The CTO gives you the whole globe, but you pay for it in taxes. Which I guess leads right into the third freedom.
Strategy compatibility.
Right.
The account just doesn't care what your strategy is. Passive, buy and hold, fine. Active trading, short selling, complex options. It's compatible with all of it. You just can't do that stuff in the more regulated, tax-friendly accounts.
But hold on a second. If the PEA has those massive tax advantages after 5 years, why would anyone even open a CTO unless they absolutely had to? Isn't tax efficiency the goal?
That's a critical question. And the answer is the CTO often isn't meant to replace the PEA.
It's a complement.
It's a necessary complement. So imagine you're building a globally diversified portfolio. You max out your PEA first, right? You fill it with all the eligible MSCI World ETFs you can find.
Okay.
But then what? The PEA is full. Or you realize you need exposure to emerging markets, or gold, or specific U.S. stocks. Assets the PEA simply cannot hold.
That's where the CTO comes in.
It becomes the next essential step. It's really the only way to get true global diversification.
So it's the overflow tank. And the key to holding assets that are, driving global growth, like those big non-EU companies. But that freedom, as we said, comes with a pretty big trade-off.
Yeah.
Let's pivot to the consequences. Let's talk taxes.
This is the major drawback, no question, because the CTO gives you all that freedom. It gets what the sources call fiscalité moins avantageuse.
Less favorable tax treatment.
Right. The government is basically saying, sure, you can play in the global sandbox, but you're going to pay us on every win.
And the key distinction is that it's not holding the asset that gets taxed, it's selling it for a gain.
Exactly. The tax mechanism is simple, but frankly, pretty punishing for active traders. Every single sale that makes a capital gain a plus value is taxable that year.
There's no waiting period. No 5-year rule like the PEA to get a tax break.
Not at all.
So what kind of rate are we talking about here?
Right.
Because that number changes everything.
The standard rate for most investors is the flat tax, 30%.
30? Wow.
Yep, 30%. And that bundles together income tax and all the social contributions. It's a significant chunk to give up, especially if you're trying to compound your money over time.
A 30% hit on every single gain means that, like high-frequency trading or swing trading, those strategies become way less profitable. You have to get incredible returns just to beat the tax man.
Absolutely. It totally changes how you think. If every gain is instantly taxed at 30%, the CTO gives you, and I'm quoting here, no incentive for long-term holding. It forces you to be really rigorous about managing your trades. If you're constantly taking small profits, you're just feeding that 30% pipeline over and over again, and it just kills your compounding.
Now, you said the 30% flat tax is standard, but the sources mentioned another option. Something about the progressive tax scale. Who would ever choose that?
Right, that's a good technical point. The 30% flat tax is the default, and for most middle to high income folks, it makes sense because it's predictable.
Okay.
But if you're a low-income earner, you have the option to choose the progressive scale instead. If your marginal tax bracket plus social contributions ends up being less than 30%, then choosing that option could save you money.
So it's kind of a relief valve for people in the lowest tax brackets.
Wait.
But for most of the autonomous, curious investors we're talking about, that 30% is the reality they have to plan for.
That's the strategic reality, yes. And that 30% levy forces you to be smart. For example, reinvesting dividends is way less efficient in a CTO because they get taxed right away, leaving you less cash to buy new shares. You have to be surgical.
Okay, so since the CTO demands so much personal discipline to fight that 30% tax drag, the platform you choose, your broker, suddenly becomes a huge deal.
It's vital. And this isn't just about finding the cheapest fees. It's about reducing friction, especially the administrative headache.
You really have to compare brokers before you commit. We've pulled 4 key criteria from the sources that should be on your checklist.
First up is ease of use. You need a platform that matches your skill level.
So are you looking for something super simple on your phone, like a Trade Republic or Boursorama? Or are you an advanced user who needs the power of, say, interactive brokers?
Exactly. Picking the wrong one can lead to expensive mistakes. Second, ETF choice. This goes right back to why you have a CTO in the first place, to fill the gaps from the PEA.
You have to make sure the broker actually offers the specific foreign ETFs you want to buy.
Right. And you should specifically check for things like French-eligible MSCI World capitalizing ETFs, the basics.
And the third one, this feels like the real deal breaker, taxation support. The key here is something called the IFU.
The imprimer fiscal unique, yes. This is non-negotiable for many.
Let's really dig into the why. Why is this IFU so important?
Because without it, you, the investor, are on the hook for manually calculating every single capital gain and loss for the year. And critically, you have to do the currency conversion from USD to EUR, for example, for every single trade.
Oh, wow. If you've made hundreds of trades, that's a nightmare.
It's an administrative nightmare. You'd need accounting software or just hours and hours of spreadsheet work. The IFU, as the source says, greatly facilitates your annual tax declaration because the broker does all that heavy lifting for you.
So the IFU isn't just a convenience, it's a safety net against making a costly tax mistake. Okay, and the last criterion is fray, or fees.
Yep, and you have to look at the whole picture here, not just the trading fee.
Compare everything: execution fees, account maintenance fees, any inactivity fees.
And crucially, if you plan to hold U.S. stocks, which is a super common reason to have a CTO, you have to analyze the currency exchange fee.
A hidden fee.
It's often hidden in the spread, and high FX fees can just eat away at your returns on U.S. assets.
Okay, let's apply these criteria to the brokers mentioned in the research, starting with the ones focused on simplicity.
In that beginner category, you have Trade Republic. It's known for a really intuitive mobile app and super simple fees, often zero-fee trades. The catch: maybe limited ETF choices.
And Boursorama.
Boursorama is very accessible, good customer support, has all the classic ETFs. Fees are, about average.
Now for that big dividing line we talked about, the tax documentation,
Hmm.
the brokers that do not provide a complete IFU.
Right, so you're taking on that admin burden yourself. This group includes some huge names, Digiro, for example, ultra competitive on fees, huge selection of funds, but no complete IFU. They offer some help, but it's not the real thing.
And there are others.
Same issue with eToro with its social trading focus, and XTB, which has really competitive zero-fee buying. You get lower trading costs, but you pay for it with complexity at tax time.
So if having that IFU is a must-have for you, and for a lot of busy people, it probably should be, you need to look at a different tier of brokers.
Exactly. And here you find some strong reputations. Fortunio is well-regarded, nice interface, and most importantly, provides the IFU.
Okay.
Then there's Bourse Direct, known for very low execution fees and a good ETF selection, though the interface is described as a bit vieillissant.
Aging. A bit dated.
A bit dated, yeah. Might not feel as slick as the newer mobile-first apps.
And finally, let's go to the top end. The professional platforms where complexity isn't a bug, it's a feature.
These are for investors who want maximum control. Interactive Brokers, or IBKR, is really the gold standard. It's incredibly professional, comprehensive. You can access options, futures, any market you can think of.
But not for beginners.
Definitely noted as a little complex for beginners. The power comes with a steep learning curve. Lynx is built on top of IBKR's system, so it's also very comprehensive and recommended for experienced investors.
And Saxo Bank.
Saxo Bank has a huge global offering, an advanced platform, but the fees are often seen as a little high compared to the deep discounters.
Okay, so let's try to synthesize all of this. The CTO gives you maximum freedom. You can access any market stocks, commodities, crypto, with no caps, no restrictions.
But that total freedom comes at a price. The price is a less friendly tax system, usually that 30% flat tax on your gains, which means the account doesn't really reward you for just sitting on things.
It demands a strategy.
It demands rigorous management to optimize your trades and fight that tax drag.
And that discipline has to start with your broker research. You need to make providing the IFU a top priority to save yourself a massive headache, and you have to really get into the weeds on all the fees, especially those hidden currency exchange fees.
And, if we zoom out a bit, once you've picked your weapon and you understand its costs, it's still on you. The CTO gives you a global reach, but you still need your own framework for making good decisions.
I want to leave you with one final thought on that from Charlie Munger. I think it perfectly captures the mindset you need for a powerful tool like the CTO. He said, take ideas where they are, but use your own brain to put them together.
I like that. The tool is flexible, but your strategy has to be solid.
And remember, it is so important to keep educating yourself. If you have any doubt about your personal situation, please consult a certified professional before you make any big decisions.
Absolutely.
That wraps our deep dive on the CTO. If you found this breakdown useful, please hit that like button and subscribe to the channel for more deep dives into complex topics. We will see you on the next one.